Chapter 16, Investments. Why do corporations invest? So generally, there's a number of reasons, but the three main reasons that a corporation will invest, and specifically invest in stocks and bonds, or stocks and debt, which bonds are, again, just a debt, a kind of debt. But the general reasons are either the corporation that's investing has too much cash on hand, and they want to kind of hedge against inflation, so they want to put that cash somewhere where it's not just going down in value. If they just keep the cash, like, in a safe somewhere, then every day as inflation happens, the value of that cash goes down and down. So even if you're not trying to make money on an investment per se, it does make sense if you have cash that you're not going to use to put it somewhere that you know it's not going to lose value over time. Okay. Then the other reasons are earnings from the investment. So, even though you may not just have a bunch of extra cash sitting around, maybe one of your ideas of a way to grow your corporation or company is through investing and trying to generate higher income through your investments. So if you're just trying to make money off the interest rate, short or long term, that would be one reason. And then finally, the last reason would be for strategic reasons. So if you're buying stock in order to try to invest and maybe take over a company by buying out a controlling interest in the stock, that would be a strategic reason for investing. So when we're talking about debt investments, and again, these are bonds, so basically when you buy a bond, what you're doing is loaning a corporation money. They're promising to pay you back that money in a certain number of years, and then in between now and then, they're going to pay you interest. Okay, so depending on the rate that's on the bond, that will depend on how much interest they're going to pay you. So when we as a buyer are contemplating buying bonds, or in other words, loaning money to a company, there's 3 points where we're going to do journal entries. At the acquisition, whenever we get any kind of interest revenue, and then whenever we sell the bonds. And if we end up holding them until maturity, in other words, holding them until that other company has to pay us back, then that would be kind of at the same point as the disposal of the bonds. Okay? But we're looking at these bonds right now from the standpoint of an investment. And so because of that, we're thinking that maybe we're not going to hold them until maturity, that we're in fact going to purchase them because we believe the interest rates will go up in the market and we'll be able to sell them at a later date before they mature for more money than we bought them for. Okay, so those are the 3 kind of checkpoints that will require journal entries of some sort. So when we actually buy the bond, this is what the journal entry looks like. It's going to be a debit to debt investments for $54,000 in this case, credit to cash $54,000. Now here we do have some language that shows us what type of bonds we're buying. 50 B Corporation 8% 10-year $1,000 bonds. But in order to record the acquisition of the bond, all we really need to know is that we're buying a bond for $54,000 or 50 bonds for $54,000. And if we know that much, then we can record this journal entry. Okay, now when we're actually looking at the interest that we're going to receive, that's when we need to know the face value of the bond. So basically it's a $50,000 bond at 8% interest. So if it pays interest semi-annually, then we're going to take that 8% and divide it into 2. So every 6 months it will pay 4% of $50,000, which is $2,000. Okay, so assuming that the first journal entry is not, or assuming that the first interest payment is before we actually need to record any financial statements, this is what just a generic journal entry would look like, showing receipt of interest revenue. So we debit cash for $2,000, credit interest revenue for $2,000. Now, for the next interest payment, assuming that we're on a July 1, January 1 schedule of paying, the fiscal year ends December 31st for this company. So as of December 31st, we've earned basically the entire amount of the next interest payment, the $2,000. And we earned that just by time passing. When 6 months passes, we've earned the interest. Okay, so we're just for simplicity's sake, we're gonna round it to as if we actually earned the entire amount. So we're gonna record a debit to interest receivable instead of cash because we don't actually have the cash. We just know we're going to receive it in the near future, tomorrow actually. But it doesn't really matter if it's tomorrow or next week or whatever. We're going to debit interest receivable, and then we're going to credit interest revenue to show that we've earned the revenue. And then as of the next day when we're going to actually receive the revenue, we're just going to cancel out that receivable. So instead of that, you see in that first entry there, we had a debit to interest receivable. Now we're going to have a credit to interest receivable for that amount and a debit to cash for $2,000 to show that the actual payment of cash has taken place. Then again, we need to know the details and the specifics of the bond purchase when we're going to sell the bond. Now, if we were the sellers of the original bond, so like the company that's actually trying to borrow money, then we would have recorded discounts or premiums if we're selling the bond for higher or lower than the face value. As a buyer of bonds, okay, we don't need to worry about that. All we need to worry about is how much we paid for it and how much we're going to sell it for when we do sell it. So we paid $54,000 for it. We're going to sell it for $58,000. So down here at this journal entry at the bottom, we have a debit to cash for $58,000, a credit to debt investment of $54,000. That's where we're showing that the asset that we recorded when we purchased this bond is going away. So it used to be a debit to debt investment for $54,000. Now we're crediting that same account for $54,000 to cancel it out. And then the difference between the cash we received and this debt investment account is going to be how much we gained or lost on this investment. So in this case, the cash we received is greater than the amount we paid for it, so we know it's going to be a gain. So we have a credit to gain on sale of debt investment for $4,000. Now let's look at stock investments. When we talked about stock investments, we talked about three categories of ownership status. So if you buy stock and that puts you in a category where you own less than 20% of the stock of this company, you record it a certain way. If you're in the category owning 20 to 50% of the stock, there's a different way. You use the equity method of recording. And then if you own 50% or anything more than 50% of the company's stock, then you, instead of using either of these methods, you're going to assume that you own the company and you will file consolidated financial statements. Okay, so let's first look at the cost method. And this is the method that we use when we have less than 20% interest in the company. And also remember that what this really is getting at is that we have insignificant or not significant influence over the company owning this amount of shares. If we say that we have significant influence even though we have less than 20% ownership, then that might bump us up into that equity method. But since we're saying this is insignificant influence, we're going to look at the cost method. Now the initial purchase, it doesn't matter which method we're using. We're going to debit stock investments for the entire cost to us of purchasing these stocks. So in this case, $40 per share, 1,000 shares, plus $500 in broker fees. So that's $40,500. Then we're going to credit cash for that same amount, $40,500. Okay. When dividends are paid, we're just going to show it as a source of revenue. So we have a debit to cash, assuming dividends paid of $2 per share. $2 times 1,000 gives us a cash dividend of $2,000, credit to dividends revenue of $2,000. And then if we go to sell this stock, again, all we really care about is how much we paid for it. We paid in total $40,500. We're selling for $39,500, so we're actually losing money on this transaction. We have a debit to cash of $39,500, showing what we received. We have a credit to stock investments of $40,500 because that's canceling out the stock asset that we had. Okay, so we don't get to decide how much that credit is going to be for, because that is just going to be the exact amount we paid for the stock. And the difference between those will be either a gain or a loss. In this case, because the cash was less than what we paid for it, it's going to be a debit to loss on sale of stock. If the cash was more than we paid for it, it would be a credit to gain on sale of stock. Now looking at the equity method. Okay, so the equity method is when we have significant influence over the company. And the percentage ownership that we talk about when we say significant influence is 20 to 50%. So, if that is the case, we record the acquisition the same way that we did for the cost method. So, assuming we bought stock for $120,000, they gave us a 30% interest in the company, we're going to debit stock investments for $120,000, credit cash for $120,000. Then we're going to look at the end of the year. So during the year, we're not concerned necessarily with all that much, but at the end of the year, we're going to look at what the net income was and what the cash dividends were. And I guess actually we would record these cash dividends as they were paid. So if this was paid during the year and not at the end of the year, that's when we'd record it. But let's just assume for simplicity's sake that this is paid at the end of the year. So first, we're going to look at the net income, and then we're going to take whatever percentage ownership we have of the company, in this case 30%, multiply that times the 100,000, and that gives us the increase to our stock investments that we're going to record. So we have a debit to stock investments, which will increase our stock investments, 30,000, and then we're going to show a credit to revenue from stock investments of $30,000. So we're recognizing revenue, our stock investment account is going up. Then to record the dividend, we need to see what is 30% of the $40,000 dividend. So 30% times 40,000 gives us the number of $12,000. That's cash that we received from the company. Okay, so we received cash of $12,000. But since we're saying that we basically own that company, what that does for us is essentially that is viewed as the return of our capital that we invested. So what that's going to be is a credit to stock investments, lowering our stock investment account by $12,000. Then when we go, assuming we had that 30% interest in the company, if we go to sell that company, or sell that interest, all the stock we own, for in this case for $150,000, we're going to record a debit to cash for the amount that we sell it for, $150,000, credit to stock investments of whatever is in this account at the time we sell it. So in our case, we have the initial amount that we had in there, and then the changes that we recorded in these last journal entries over here. Okay, so we had an increase of $30,000 and a decrease of $12,000, which gives us a net increase of $18,000. So we started with $120,000 with a net increase of $18,000. We ended up with $138,000 in the stock investment account. So we're getting rid of all of that we have still in the account, and the difference between what's still in that stock investment account and the money we get will either be a gain or a loss. In this case, because cash was greater than what we have in the stock investments, it's going to be a gain of $12,000. Consolidated financials, again, all that basically means is you are the owner of the company. You have control of that company. So if that is the case, the company that purchased the 50% or greater than 50% interest in the other company is called the parent company. The company whose stock was purchased is called the subsidiary company. And for the purposes of this class, all you need to know in that situation is that that then requires consolidated financial statements, which means the parent company will issue normal financial statements, the subsidiary will issue normal financial statements, and then the parent company will also issue a consolidated financial statement showing its entire financials, including all of its subsidiaries. Okay, so now we're going to look at how we're going to treat these investments on our financial statements at the end of each year. Okay, so all we're really worried about is the scenario of where if we're talking about stock, where we own less than 20% of the company. If you own less than 20% of the company, then you need to pay attention to how much those stocks are worth at the end of the year. And we basically have three ways to value those stocks. You can do it by cost, fair value, or lower of cost or market value. Okay? So if you're doing it by cost, then you're just keeping track of what you paid for it. If you're doing it by fair value, all you care about is what it's worth right now. If you're doing by lower of cost or market, that's just a conservative way of saying that you're going to record whatever the lower cost is. So you look at cost, you look at market, whichever one is lower, that's what you're going to record. Okay, most people argue that fair value makes the most sense because that's what you can actually exchange for cash right now, for that much cash. So for the purposes of valuation, there's three different categories of securities. We have trading securities, which are very short term, and the whole intent that we have of purchasing these is to quickly sell them again for a gain. Available for sale securities are longer term. There's no set specific time period, but I would say at least 3 months or longer, and it could be up to numerous years. But these are stocks that you plan on selling probably eventually, but just not in the immediate future. So you could hold on to them. Basically, these types of stocks you're generally not going to sell for a loss unless you wait years and years and years and the stock price never goes up, or there's some catastrophic event that makes the stock worthless. And then the last category is held to maturity securities, and these are just bonds that you don't plan on selling. So you buy the bond, you loan someone money, you get interest back from them, and then finally they pay you back the money they owe you. So first let's look at trading securities. With trading and available for sale securities, we're going to look at what the fair value of these stocks or bonds are at the end of the year. And whatever that is, we want to make an adjustment to show the difference between what the fair value is and what the cost was to us. So in other words, we want these stocks to reflect current market value. The only real difference between trading and available for sale securities is the names of these adjusting entries are slightly different, and that reflects the fact that for trading securities, the unrealized gain or loss will show up on the income statement. For available for sale securities, it will not. It will only show up on the balance sheet. So when you're looking at how the finances look for this current year, and you just want a snapshot of this year, how your company's done, you're not going to include any unrealized gain or losses unless they're in this trading securities category. So if they are in this trading securities category, let's assume that we have some stocks that went up by $7,000 in value. So when we're about to do financial statements, we're going to debit a market adjustment to trading securities for $7,000, which will show an increase in the value. And then we're going to credit an unrealized gain on the income statement of $7,000. So that will show up on our income statement. And if this was a loss instead of a gain, then you would just kind of flip-flop these, and the market adjustment would be in the credit category. And then instead of this being an unrealized gain to income, it would be a debit and an unrealized loss to income. Now, like I said, available for sale securities, very similar. Same accounts here at the bottom in the journal entry. The only difference is the last word. Equity here on the debit instead of income, and available for sale on the market adjustment instead of trading. So the available for sale distinction just shows that it's an available for sale security and not a trading security. So it keeps those separate for the market adjustments. And the equity just shows that that unrealized gain or loss is going to show up on the balance sheet instead of the income statement. So this example down here is just an example of available for sale securities that decreased by $9,000 in value for the period. So we have a debit to unrealized loss of equity, $9,000, credit market adjustment available for sale, $9,000. Now if this was a gain instead of a loss, again we just flip-flop these and it would be a debit to market adjustment available for sale, $9,000, and a credit to unrealized gain equity, $9,000. Okay, we know that for market or for balance sheet purposes, um, basically to be considered a current asset or a short-term investment, the stocks have to be readily, or the securities have to be readily marketable, so you have to be able to sell them. There can't be any stipulations that don't allow you to sell them immediately. And you have to have, and I know this is very subjective, but you have to have the intent to convert in the short term. So you have to be planning to sell them very quickly. Otherwise, it's considered a long-term asset. Okay. And again, this just will make a difference on where it's displayed on the balance sheet, whether it's in that first current assets category or the second category, which is long-term assets. And the only thing that really affects is certain management accounting ratios that will be looked at by stockholders and sometimes by internal management to determine how well a company is able to pay its short-term debts. There are various ratios that deal with short-term money situation, and obviously those look at current assets versus current liabilities. So that's where that comes into play. And when an unrealized gain or realized gain or loss is reported on the income statement, it's important to know that the initial net income before the adjusted net income, so when you just have revenues minus expenses, unrealized or realized gain or loss on securities does not factor into that. You have your net income, which is just revenues minus expenses, and then you'll have a couple of what we call below net income items that take net income and transform it into adjusted net income. So one of those would be a gain or a loss from something that is not part of your operating activities, and that's what, unless you're a stockbroker or an investment banker, the buying and selling of stocks and bonds are not part of your normal operating activities. That's just kind of a tangent project that you would be working on. And the main reason for that is just so people are able to look at how the operation went for the year without having fluctuations year to year in the value of securities you're holding, because that really doesn't help a lot to determine how well the company's doing. That just helps to know how well they're investing their spare cash or whatever they're doing with those stocks.